In this video, we'll be looking at Bybit's Crypto Loans feature, which is where you can borrow against the value of crypto that you have on the platform. So we'll be looking at actually taking out a loan, paying it back, the interest that's paid, and then the other important aspects of taking a loan. Timestamps down below for everything. Bybit Crypto Loans use something called over-collateralized lending. That is, we need to put up some crypto on the platform as our collateral. That's our safety net. And that's right here. So collateral amount. I'm going to use Bitcoin to make it simple, but you can see pretty much all major cryptos are supported. So if you have a crypto with some value, you can put that up as collateral. Now, what do you borrow against that collateral? Well, up here, I'm going to use dollars again to make it simple, but you can pretty much borrow anything against it. So as long as you have some crypto and it has a value and it's supported here, that value can be put up and you can borrow against that. Now, this is known as over-collateralized lending because we have to put up more value in Bitcoin or crypto than we can borrow against. In fact, if you look here, for most crypto assets, or it may change, but for Bitcoin anyway, 80%. That means that if we put up $1,000 worth of BTC, we can only borrow $800 against it. That 20% buffer is a buffer for Bybit, essentially to there's so much volatility in crypto. And so if the collateral moves in price down and we don't pay it back for whatever reason, they have a buffer there to wait and then eventually to sell the assets, sell the collateral to pay back the loan that we made. Obviously, we don't want to do that. We're going to pay back our loans. We're going to pay a bit of interest, no problem. But that's essentially it. So we have an amount in collateral, over-collateralized lending. Why would you want to borrow that? Well, crypto has many ways to make yield and other trading opportunities. And so you don't want to sell your collateral, you don't want to sell your Bitcoin, but you can borrow against it a little bit, pay a small interest, and then invest it elsewhere if you want. Let's go through the important aspects of taking a crypto loan out on Bybit then. So the first thing is, how much can you loan? Like I said, it's 80% loan to value, which means only 80% of the collateral. Down here where it says collateral amount, I've got some Bitcoin in my unified trading account. However, you can flick between unified trading and funding account if you want. So if you want to keep assets in one of those accounts, you can use that as collateral. So that's fine for me. So I'm using the Bitcoin in my unified trading account and I'm just going to borrow $50 against it. And it says, this is how much collateral you need to put up. This is how much Bitcoin you need to put up. Now, if I click maximum here, it's going to show me exactly how much I can borrow against that BTC. So for right now, I'm putting up all of the collateral that I have in my unified trading account, and that tells me that I can borrow around 450 USDT. If I switch this to another crypto, it's going to work out the differences, right? So it's going to say you can borrow this amount of this crypto, whatever it is. I'm going to switch back to USDT. Now, on the right-hand side, you have initial LTV, margin call LTV, and liquidation LTV. This is the important part of the loan. So like I said, $1,000 of Bitcoin, the initial loan to value, we can borrow 80%. So the loan to value of your collateral, 80% of $1,000 is $800 if you had $1,000 on there. So you could borrow $800. Now the margin call ratio is when your collateral changes in price and it goes down, right? We go down in price because Bitcoin is volatile. So let's say we borrowed that $800 against $1,000 of BTC. Our Bitcoin actually loses value a little bit. Then the loan to value will actually go up, right? Because we've borrowed a fixed amount of $800 and the Bitcoin is now worth less. So if that ratio hits 87%, we get a margin call. It won't be a call, it'll probably be an email or a push notification, right? And Bybit will say, hey, look, you've borrowed 87% of your collateral value at this point. We need to sort this out. Please put more Bitcoin on account to reduce the loan to value. Or you can pay off the USDT if you want, and that will reduce the loan to value as well, right? And then the liquidation LTV is if the Bitcoin falls further and that $800 you borrowed makes up 95% of your collateral, they will actually liquidate you. So that means they will go ahead and sell the Bitcoin to pay back the loan. That's fine. You get a 2% fee for doing that. So if they do liquidate your position, they will liquidate, sell the Bitcoin, pay back the loan, and charge you an extra 2% as a liquidation fee. But that's it. So if that happens, that's the worst case scenario where your Bitcoin will get liquidated, you pay back the loan, and that 2% fee. So that's what these mean on the right-hand side. And it's pretty important to obviously keep a look at these when you're taking out your loan and through the life of the loan. We can also choose the loan term on Bybit. And at first glance, you may think this is just about the amount of time that you take the loan, but this is also in relation to the interest rate that we pay. So the loan term right here, where it says flexible, this actually means that the interest rate that we're paying is flexible or floating. So let's say we take out a loan right now and we borrow, the interest rate that we're paying now is 5%. That's an annualized figure, so that will be 5% annualized, but it's worked out on an hourly basis, I believe. So if you actually had the loan for a whole entire year, let's say $1,000, you'd pay $1,000 plus 5% back. However, if you take it out for an hour or 5 hours or a day, then obviously it's going to be a lot less in terms of the nominal amount that you pay. But if it's annualized, it would be 5%. In any case, this rate is floating or flexible, meaning today it could be 5%. However, if the loan carries on and you don't pay it back, that rate could actually move up, could move down. Now, if you want to fix the interest rate, then you can do, but with a fixed interest rate, then you also need to fix the length of the term, right? Because no one's going to give you a fixed interest rate indefinitely. So as we can see here, if you do want to fix it, you also need to fix the term. However, you can actually pay back all of these loans early. So even if you want to fix your rate, let's say at 11.5% for 14 days, after 6 days, if you want to pay back the loan, you can do. And so it's not a fixed term loan in terms of the amount of time. You're just fixing it with this interest rate for this amount of time. You can pay it back early if you want, but if you don't, you obviously need to pay back after that 14 days. Otherwise, you get some fines. So for right here, they actually charge you 3 times the interest after the expiry date. So let's say you take out a loan this for 14 days. After 14 days, you are expected to pay it back. It doesn't pay back automatically. You have to do that manually, and there is a grace period. And after the 14 days expires, they will immediately start charging you 3x the interest rate that you agreed to. And within that grace period, which changes depending on the terms, but it's usually maybe a few hours to maybe a day or so, after that grace period, they will actually just liquidate the position and pay back. So it's up to you to manage your loans because there's lots of small charges that you don't want to, be paying. Let's go ahead and take a dollar loan against Bitcoin collateral then. So the collateral amount it tells me that I need is this much for a $50 loan, and I'm going to pay flexible interest for now. On the right-hand side, it tells me what the liquidation price is. That is, if Bitcoin does fall down to this price, my loan would actually fall into this 95% threshold, and they would liquidate the Bitcoin in order to pay back the loan. That's a long way away from the current price, so we're good for that. And it tells me my daily interest. We're going to click borrow now, agree to the terms, and click yes. And that should go ahead and borrow the dollars for me. The $50 is going to go into my unified trading account, I believe. So you have that immediately to go ahead and actually trade with on Bybit, or of course you can move it around any way that you want. Bybit don't care what you do with this because they've got the collateral tied up to pay for this loan anyway. So they don't care what you do with it. You can do anything with it, trade it, take it off the platform, whatever, as long as you either pay it back, or if you don't, they're going to liquidate you to pay it back anyway. Now that we have an active loan, we can see the details of it. If you go to details on the right-hand side in my borrowings, you can see the interest here. This is a flexible rate, so we need to keep an eye on this daily. What we can also do is adjust the collateral amount. This is actually changing the amount of collateral that you have in the position. So remember, we've tied up Bitcoin here, and if anything goes wrong, Bybit are going to liquidate that to pay back the loan. So I'm going to click adjust collateral amount. Now, what happens if Bitcoin falls in price a little bit and my loan to value starts going up? I don't want to get liquidated. I've got extra Bitcoin. I don't want to pay the 2% liquidation fee. I don't want to do that. I've got the dollars tied up. So what I can do is add some more Bitcoin to the position, and that will increase the amount of collateral I have and therefore reduce the loan I have to the value of my collateral. So my loan to value is going to be coming down if I add in some BTC here. So I do have some BTC, so I can press an amount that I can actually add in. And what we're doing is increasing the amount of collateral. You can see that the current loan to value is 81%. And if I added all of this in, the loan to value after that would be 9%, which would move down the liquidation price. I basically paid off most of the loan at this point with my BTC, but maybe I've got the dollars tied up elsewhere. If I want to do that, press confirm, and you can add that to the position, reduce the loan to value. I'm going to repay this loan now, plus the interest that has accrued. As of right now, you can only pay back the loan with the asset that you borrowed. So I've borrowed USDT. I must repay in USDT. I can't use another crypto asset to repay. I can't use the Bitcoin to repay. I need to use USDT to repay. If you get liquidated, Bybit sorts that out on the back end, but that's not our choice. So we're going to press repay. We must have the amount of USDT that is required here to pay back the loan. So I borrowed $50. You can see right now, I'm actually paying back 50 plus this tiny bit of interest that we've accrued. So I'm going to do that. And that USDT is going to come out of my unified trading account right here. If you have USDT in your funding, you can just switch this down. But I've got this in my unified trading account, so I can go and press confirm, and that repays the loan. If you are new to Bybit, you can get a deposit and trading bonus. Link down below in the description for that. Some other helpful videos down there as well. I'm James, this is Money DG. Cheers for watching, and I'll see you in the next one.